Hello, very good morning to all. Hi, very good morning to all. Welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Tuesday, the 3rd of September 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any projection, forecast, prediction in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into the short-term intraday technical outlook on the various broad-based cross-asset classes, let's have a recap what has taken shape yesterday in terms of cross-asset classes performance, its news flow, and as well as its respective key economic data, if there is any. So what we could see yesterday was a rather quiet session. Why? Because the US cash or stock market is being closed for Labor Day yesterday. So we do not have any things to share on the US stock market intraday performance perspective. But from a FX dollar performance perspective over here, as you could see on my chart, okay, though this is the latest 5-day rolling performance as we are speaking right now. So what we could see over here is that the dollar has started to gain strength across the board. I would say against the other major so-called major currency. Particularly the dollar is strengthening pretty much quickly on a very short-term basis because it's a 5-day rolling performance on the dollar yen. So that actually also came in within our expectation. For those who follow our daily dose of market insight yesterday, there was a break above the 145.45 key short-term resistance on the dollar yen that kickstart this ongoing mean reversion rebound in the dollar against the other major currency. Okay, so primarily speaking, it seems to us that it still remains in motion at this juncture. Okay, so let me do some adjustment over here. Okay, so this should be as of now, 3rd of September. Okay, let me see whether I can change the date or not. Okay, never mind. So just bear in mind that this should be 3rd of September because it's based on the current price action right now, based on this 5-day rolling performance. Okay, good, it came up. Okay, as of now. Okay, 3rd September. All right, so yesterday was also there's no key economic data releases in the US session because the US stock market is closed, and also from the Eurozone side of the story, there's no economic data release. But there's this particular news flow that I'd like to share with you all. Is more pertaining to China trade relations with the world. So yesterday, Bloomberg reported that there was a warning coming out from China policymakers towards Japan on the retaliation for possible new chip curbs. That means, i.e., as you know that US, the current administration, Biden right now is pressuring Japan, not even Japan, and its close allies like South Korea and Holland, Netherlands, to actually adhere to much more stringent sharing of equipment, or I would say exporting of technical know-how and semiconductor related making equipment, especially on the higher end of the semiconductor change to China. And China retaliated verbally yesterday by indicating that they will actually starts to actually put pressure on Japanese products towards China. That means, i.e., Japanese export towards China, and that's most likely targeting Japan automobile sector, which is Toyota and Honda. So that could actually potentially see a bit of minor downside risk taking shape on the Nikkei 225. Still bear in mind, yesterday, for those who actually follow our daily on market insights, we flipped to a intraday bearish bias on the Nikkei 225, given the fact that the last 4 weeks of rally has hit a key short-term resistance level, and potentially there could be some form of mean reversion decline, at least in the short term, from the technical perspective. And very interestingly, it kind of gel in line with this negative news flow towards the Nikkei 225 reported by Bloomberg on the possibility of China retaliation towards Japan if Japan starts to actually adhere to the latest trade policy being depicted by US on sharing or transferring semiconductor, high-end semiconductor know-how or supply to China. Okay, so this is one of the rather important news flow that I shared with you all yesterday. And on the hand, there is no data to share on the US stock market performance yesterday since that is closed. Let me straight away now jump straight to the fundamental and intermarket perspective for a medium-term perspective, which I'm going to share with you pertaining to the Aussie dollar. Okay, so on the Aussie dollar, I want to share with you all by looking at this particular chart at the top, right? You could see my screen over here. So the one that this is a weekly chart, it's a weekly time frame. So the one in dark blue will be the Aussie dollar FX rate, that means the Aussie slash USD, and the one in bright pink, or I would say that a bright pink level, will be iron ore futures pricing. To be precise, is iron ore CFR China futures. Is one of the more liquid iron ore futures contract that is being traded over at our Singapore exchange. Okay, so I did the perpetual contract by linking prior expired futures contract to do a trend analysis. And when I overlay with the Aussie dollar, we realized that since the pandemic, March 2020, it has been trading in a direct lockstep. That means, i.e., if you look at the movement of the iron ore China futures, it's more or less in line, direct in line. That means we talk about direct correlation with the Aussie dollar. So every time it shaped a significant decline, especially one from September, I would say over here, July 2021, all the way to November 2021, it actually exert downside pressure on the Aussie dollar. And thereafter, since the low of 24th of October 2022, all the way up to March 2024 this year, it has been trapped in a kind of a sideways range, all right, on the iron ore futures pricing, and that led the Aussie dollar to trade within this sideways range as well. And its correlation, its direct correlation starts to break down after 5th, since 5th of August this year, this dotted turquoise blue line over here, where the Aussie dollar rallied higher, but the iron ore price, futures price, continue to inch downward. Right, so there was really a break of this recent direct correlation between the iron ore China futures pricing and the pricing on the Aussie dollar. And one of the reasons why the Aussie dollar rallied pretty sharply from the low of August 2024, 5th of August 2024, is due to that resurgence of the global risk-on behavior that is being depicted in the equity market. All right. So right now, with the equity market has already almost fully priced in upcoming interest rate cut cycle that's going to kickstart in September FOMC meeting, the market right now will concentrated more on the growth narrative story, global growth narrative story that could potentially impact the Aussie dollar, given the fact that the Aussie dollar is a high beta currency. What do I mean by high beta currency? That means they move much as a faster speed if there is anything related to growth. All right. Over here, if growth story starts to come back into the picture, the Aussie dollar will tend to rally much faster. And if the growth story start to deteriorate, the Aussie dollar will tend to slide at a faster rate. Okay, this is what I mean by a high beta FX pair, the Aussie dollar. So as you could recall, yesterday I do share with you all there's this important data out from China, which is the MBS manufacturing PMI data that is actually not out yesterday, it's out on Saturday. So let me go back to my screen again, previous week over here. Okay, so on the previous week on Saturday, the release of the China MPS manufacturing PMI data is rather weak and lackluster. It actually continues to be in a contractionary mode, 49.1, way below market consensus of expecting at 49.5, and also below 49.4 that was printed in the previous month of July. So if you look at the previous trend of the MBS manufacturing PMI in China, it continues to actually decline, showing 4 months of contractionary, we call it a state or contractionary condition in manufacturing activities in China. So we know that manufacturing activity in China starts to decline, and given the fact that the China housing market is also not showing no signs of a clear stabilization in its persistent downtrend, there is potentially less demand for industrialized metals. All right. So what's meant by industrial metals? Industrialized metals are being used for infrastructure, and infrastructure activities are related to manufacturing activities and related to activities in the housing market. Both of them are still lackluster from the latest data point view. So, i.e., that could actually see less demand for iron ore, which is one of the industrialized metal. And we know that iron ore, in terms of a global resource perspective, Australia produces the most iron ore globally, and its key export market is in China. So given that the fact that China manufacturing activity starts to be in a sluggish mode, the property market is not showing signs of stabilization after a series of persistent negative year-on-year growth, that could actually see lesser exports of iron ore from Australia to China, which eventually will put downside pressure on Australia trade balance, which potentially could see the Aussie dollar moving in line with the iron ore price going forward. That means there could be some form of downside negative feedback loop that being potentially reinsert itself back to the Australia dollar. So what you could see over here is that if our the bottom of the chart is I did another candlestick chart on the iron ore CFR China futures, very obvious we start to see that it's clearly trading in a medium term and translating itself into a potential downtrend going forward, major downtrend, as well as price action continues to remain capped by the 50-day moving average, acting as intermediate resistance at 104.95. And right now it's showing a further downside momentum by now trading at negative 5.5% day to week to date. All right, week to date. This is the current week versus the weekly chart, and it seems to us that potentially from a technical analysis perspective, there could be further downside pressure to retest this long-term major support level at 78.70 that is in place since November 2019. So if this iron ore price continues to inch much downwards, not surpassing 104.95 key medium-term resistance level, that could start to see a potential reassertion of the direct correlation on oil prices with Aussie dollar. That means, i.e., the Aussie dollar could actually revert into its downside momentum again, in line with the weakness of the iron ore prices. That means their correlation now move in direct lockstep. So at least from a technical perspective, we could see a revisit of the Aussie dollar to actually go back down towards the low level at around 65, 66 figure level. Okay, at least from a multi-week perspective. All right, so this is the intermarket dynamics currently that I will share with you all that is taking shape in the Aussie dollar. All right, so with that, now let us now jump straight away into the short-term intraday technical outlook on the major cross asset classes. But before that, let me expand my screen so that you guys could have a better look at the key levels. Okay, so let us start with the FX market, all right, which is the euro dollar. So we know that the euro dollar yesterday we flipped to a bearish bias due to the potential mean reversion rebound coming into play into the dollar FX market. That means i.e. some form of short-term mean reversion rebound in dollar strength. So no change, the price action continues to languish and it's hard to inch downwards again, revisiting the first intermediate near-term support at 110.50. So still using 111.05 as my short-term pivotal resistance level on the euro dollar, still maintaining that short-term intraday bearish bias on the euro dollar. A breakdown below 110.50 exposes the next near-term support on the intraday basis at 110 figure level. All right, only an hourly close above 111.05, that means a breakout above 111.05 short-term pivotal resistance will invalidate today's intraday bearish bias on the euro dollar to potentially see a recovery scenario on the euro dollar to expose, at least in near term, revisit the intermediate resistance or near-term resistance of 111.40 and potentially even 112 figure level next. So that's for the euro dollar. Now, immediately shift our focus to the sterling dollar. So the sterling dollar continues to exhibit very similar weakness with the euro dollar as well, not able to break above 131.90 that was highlighted yesterday as our short-term pivotal resistance. So if that's the case, we still maintain that intraday bearish bias on the sterling dollar using 131.90 short-term pivotal resistance. Near-term support level to watch out for in the first step of this ongoing minor corrective decline phase of the sterling dollar to actually shape that mean reversion decline back to retest the rising 20-day moving average will be at 130.80, followed by 130.40 next on the intraday basis. On a alternative scenario where we potentially see a breakout with an hourly close above 131.90, then it will invalidate today's intraday bearish bias to see a recovery scenario taking hold on the sterling dollar, revisiting 132.65. That is the minor swing high of 28th of August. Above it, set sign on the next intermediate resistance at 133.40 next. Okay, 133.40 next. That's for the sterling dollar. So now shifting our attention to will be the Asia Pacific currency against the US dollar, starting with the Aussie dollar. So the Aussie dollar is still recall yesterday we flipped to a short-term intraday bearish bias, and also just now I shared with you all with that intermarket correlation with the iron ore futures price that is shaping a bearish dynamic that could also put some form of downside pressure on the Australia dollar as well. And given the fact itself, it starts to actually exhibit clear technical negative elements, at least on a shorter term perspective, by the bearish breakdown of this former ascending channel from 6th of August. All right, so it's still in the midst of shaping this mean reversion decline to retrace certain portion of this minor uptrend phase that has taken shape since 5th of August towards at least towards the 20-day and the 50-day moving average for this mean reversion decline to take hold. So no change. The first support resistance level that it managed to shape that bearish reaction will be at 67.90 over here. So with that, since it managed to shape the bearish reaction, I will actually use this as my Titan short-term pivotal resistance for today. All right, so instead of 68.20, okay, I will tighten it to 67.90, 893, precise ST pivot. Okay, put it in red. All right, over here. Okay, so this will be my Titan key short-term pivotal resistance, 67.93. So as long as this level didn't surpass to the upside, we'll still maintain this ongoing bearish intraday bias on the Aussie dollar. Near-term support level to watch as this retracement plays out or mean reversion decline plays out will be 67 figure level, which is corresponding to the rising 20-day moving average as well. A break below this sees the potential extension to revisit 66.40. Next near-term support level to watch. Only an hourly close above 67.93 will invalidate today's intraday bearish bias to see a revisit of last Thursday swing high area 68.20 and potentially even 68.50 next on the Aussie dollar. All right, so now let us now shift our focus now to the dollar yen. So the dollar yen continues to actually rise. Yes, oops, where's the dollar yen? All right, over here. So the dollar yen yesterday's actually shaped that bounce over here and almost hit our resistance level at 147.50. And what's interesting over here is that upon shaping that series of higher high, price action go higher high, but the RSI starts to shape a lower high, okay, at the overbought region as well. So telling us there is some form of potential intraday bearish exhaust, I would say that intraday bearish element has starts to actually unfold on the dollar yen. That means this push up over here since last Friday is losing its upside momentum, and potentially on a intraday basis, it could shape a minor pullback over here. All right. So what we can do over here is that this is an intraday basis, not a multi-day basis. From an intraday basis, using 147.50 as my short-term pivotal resistance level over here. All right, so I will actually potentially flip to an intraday bearish bias, but only looking for the first next near-term support to come in at 145.55 slash 15 level, this congestion zone over here. Then thereafter, if the price action comes close to this level, it could now form another potential new up leg to resume its ongoing rebound in the dollar yen, given that the fact that the other major FX currency is still supporting some form of short-term mean reversion dollar strength coming into play. And this 155.55 slash 15 near-term support congestion level also correspond to a key Fibo retracement ratio, which is the golden ratio at 61.8%, taking from the low of 28th of August all the way up to yesterday's intraday high. All right, only hourly close above 14750. That means if the price didn't actually shape down and test this support level, and instead it just from here it U-turn and break up, then that will invalidate today's intraday bearish bias for that kind of minor pullback or minor retracement to resume this mean reversion rebound scenario to expose or the next intermediate resistance at 14930 next. All right, so that's for the key intraday levels to watch out for and its potential price action involvement going forward from the dollar yen. Okay, with that, that sum up the short-term intraday technical outlook on the major FX pair. And for today, let me share with you another FX cross pair. So we know that FX crosses is taking out the dollar and trying to look out for other potential technical configuration that is very interesting playing out. And one that is playing out over here is the sterling Aussie. That means basically is getting out of the US dollar, comparing sterling against the Aussie dollar. So we call it the sterling Aussie rate. So the sterling Aussie FX cross pair, since its low of 20th of August, it managed to actually help right exactly at this 50-day moving average, which is in dark blue, and it seems to us that it's now evolving within this minor sideways range configuration, and price action now start to show bullish momentum after retesting its 50-day moving average in yesterday's US session, and it staged a bounce, and right now it is clearly breaking out above the 20-day moving average and yesterday's intraday high at 19430. So using the 50-day moving average as a short-term pivotal support level for today, 19340, we do have a potential bullish bias scenario on the intraday basis for the sterling Aussie dollar pair. Next resistance level to watch for sure will be its minor range stop resistance at 19530 level. All right, a break above 19530 level potentially could expose the next near-term resistance level, which is this congestion here at 19640 next. All right, but unless this 19530 is being taken out. All right, 19630. Okay, but however, if it starts to have a hourly close and a breakdown below the 50-day moving average, which is the short-term pivotal support that we have today on the sterling Aussie at 19340, then this intraday bullish bias will be invalidated to see a potential slide to expose the next near-term support level at 12990, 12950 next. All right, over here, this congestion area from 12th of June, 14th of June, and retested on 17th of July. Okay, so that's a very interesting technical development that is taking shape on the FX, one of the FX cross pair, which is the sterling Aussie that I will highlight today. Right, so with that, let us now shift our focus to the major stock indices, starting with the Hong Kong 33. So for those who follow our daily dose of market insight yesterday's Hong Kong 33 price action shaped that bearish element where we flip to a intraday bearish bias, and price action indeed today's Asia session at the start it opened lower and almost hit the upper limit of our first near-term support zone at 17,540 slash 17,430. So with that, we will have a tighter key short-term pivotal resistance today, very close to today's intraday session high right now at 17,745. So using this tightened key short-term pivotal resistance 17,745, we will still maintain that intraday bearish bias on the Hong Kong 33, i.e. the Hang Seng Index. A breakdown below 17,430, which is the lower limit of this near-term support zone, will also correspond to the 20-day moving average, will expose the next near-term support zone, the next support zone at 17,270/17,185. We also correspond to the 200-day moving average. And from a Fibo retracement perspective, if you retrace this the prior minor up push move from 5th of August all the way up to last Friday minor swing high, that correspond closely to the golden ratio as well of 61.8%. All right, only an hourly close above Titan key short-term pivotal resistance for today, which is at 17,745, will invalidate today's intraday bearish bias to see a recovery to retest 18,070/160 and even 18,350 level. If 18,160 is taken out, that is the minor swing high of 12th of July. All right, okay, now with that, let us now jump to the Nikkei 225. So like I mentioned earlier, we do have a negative news flow that is reinforcing our bearish technical bias on the Japan 225 to at least see a bit of retracement to retrace its prior up move in short term for 5th of August all the way up to this yesterday's intraday high. So no change, still using 39,270 as my short-term pivotal resistance level. First support level to watch will be 38,280. A breakdown below it, revisit 37,480 in first step, which correspond to the 200-day moving average, I think as a support level as well. However, if price action instead of moving down, it starts to pierce up above 39,270 by having an hourly close above it, then today's intraday bearish bias will be invalidated to resume its impulsive up move sequence to expose the next near-term resistance level at 40,055, followed by 40,400, which is the congestion area of 18th of July. All right, so that's for the Nikkei 225, i.e. Japan 225. Now, shifting our focus to one of the major European benchmark stock index will be the German 30. So the German 30 yesterday came down and hit the first support level at 18,820 before bouncing, and it's now continues to actually trade below this former minor ascending channel. Support now turns into a pullback resistance, and with the hourly RSI still being kept by a parallel resistance as depicted by this descending trend line over here. So with that, still no change, still 19,025 as my short-term pivotal resistance level. We will still maintain that short-term intraday bearish bias, but it got to have a clear breakdown below 18,820, which is managed to survive yesterday in order to expose the next an extension of this minor corrective mean reversion decline phase to take hold to expose the next near-term support level at 18,550 in the intraday basis. But however, if price action starts to break up with hourly close above 19,025, then today's intraday bearish bias will be invalidated to kickstart a recovery impulsive movement scenario to expose the next near-term resistance at 19,170. Above it sees 19,330/19,370 next. Right, moving our focus will be the US Wall Street 30. So yesterday, we know that the US cash market is closed. So from a futures market perspective, where our CFD prices take into its pricing, doesn't really change much, try to move a very tight sideways range. So no change, we will still use the 41,060 as my key short-term pivotal support level on the US Wall Street 30. Above, still maintaining that short-term intraday bullish bias. Above 41,535 sees the next resistance coming in near term at 41,800. Only a bearish push down and a breakdown below 41,060 will potentially invalidate today's intraday bullish bias on the US Wall Street 30 to kickstart a mean reversion decline scenario to expose the next near-term support level at 4870, followed by 4610 level, which is very close to this rising 20-day moving average as well. So that's for the US Wall Street 30. Lastly will be the Nasdaq 100. So Nasdaq 100, no change, continues to trap between 19,630 and the short-term pivotal support level that we have after the release of NVIDIA results. So 19,117 will remain as our short-term pivotal support level. You got to clear above 19,630 to at least break out from this minor sideways range scenario that has been in place since 29th of August to expose the next near-term resistance level at 19,900. All right, so with that, if price action starts to break down below 19,117 with an hourly close below it today, then that will invalidate today's intraday bullish bias to kickstart another round of mean reversion decline scenario on the Nasdaq 100 to see it extending its decline from 22nd of August to expose the next near-term support level at 18,680 next on the Nasdaq 100. All right, so that sum up the intraday technical outlook on the major stock indices. So now let us focus on the commodities market, starting with gold XAU/USD. So no change for gold as it continues to trade in a sideways range ahead of this week key economic data release, which is the ISM manufacturing PMI. Later I'll share with you on the economic calendar, and the services PMI, which on Thursday, and followed by Friday US non-farm payroll data, together with its unemployment rate as well in the US. So with that, still no change, still using 2,473 as my short-term pivotal support. Why is this level important? Because it corresponds to the rising 20-day moving average, and as well as the former range triangle range resistance that was drawn from 17th of July to 14th of August, being taken up, retested on the 22nd of August before bouncing out and retesting its current all-time high at 2,532. So this will be a pullback key support level, at least in the short term, confluencing with the rising 20-day moving average at a similar support level at 2,473. So as long as 2,473 short-term pivotal support holds, still maintain that short-term intraday bullish bias on gold XAU/USD. For sure, the first resistance level to watch out will be 2,532. Only a clear break above this 2,532 potentially shape a series of higher high to expose the next resistance zone at 2,588/2,595. Only a breakdown with an hourly close below 2,473 will invalidate today's intraday bullish bias to kickstart a mean reversion decline scenario to revisit the rising 50-day moving average, which is also acting confluencing at the next graphical support zone of 2,435/2,415. Now, lastly will be the West Texas crude oil, WTI crude. So WTI crude yesterday, we flipped to a bullish bias. Why? Because price action is coming very close to the medium-term range support level as depicted by this symmetrical triangle range configuration on the daily chart that is been tracked since the low of March 2023. So price action yesterday shaped a bounce right exactly after retest of it yesterday, this dotted green line over here. So with that, it actually also manages to hit our first resistance level yesterday at 7507 that we depicted. So no change, still keeping the 73.15/72.24 as my short-term pivotal support level. Still maintain this potential mean reversion rebound scenario for West Texas crude oil, as the hourly RSI also continues to shape a series of higher low and hasn't yet hit the overbought region yet. So above 7507 exposes the next near-term resistance at 7645. Right, only a breakdown below 73.15/72.24 will start to see a bearish breakdown scenario below the symmetrical medium-term symmetrical triangle range support to expose the next support level, at least on an intraday basis, at 71.35 followed by 70.40. So what 70.40 and 7.35 is in fact this congestion area over here, which is from 2nd of Jan and 2nd of January to 17th of January this year. All right, so that sum up our technical outlook on the West Texas crude oil and as well as the broad-based cross asset classes. So before we go, let's take a look at the calendar again. What are the key economic data to look out for today that could impact the price action of the broad-based cross asset classes? Okay, give me a minute. Sorry, I think the data is hang right now. Okay, good. It's up again. Oops. Okay, what's going on? Okay, let me go all the way up. Okay, it's very slower. Okay, so let's go to this week data. Okay, so today will be Tuesday. So on Tuesday, over here during the European session will be rather quiet. So the action will come at 10 p.m. Singapore time, where we will start to see the ISM manufacturing PMI data release, telling us the state of the health of the US manufacturing activities or manufacturing sector. So market is expecting a slight improvement to 47.5 after a contractionary reading of 46.8. And also good keep a close eye watch on the employment sub-index or sub-component of the manufacturing PMI. Previous data shows 43.4, which is rather weak. So based on trading economic forecast, it is expecting it to come in at roughly the same momentum at 43.6. And other than that, there are no other key economic data to look out for today. And in tomorrow Asia session, very early tomorrow Asia session at 9:30 a.m. before our daily dose, we'll see the release of Q2 Australia GDP growth rate that could potentially impact the Aussie dollar, followed by 9:45 a.m. The Caixin Services PMI. So that is more of a PMI data compiled by Caixin, not the official MBS data. So this Caixin PMI data do have a much more survey on the SME companies in China on top of those large corporations that is kind of more centered on the official MBS PMI data survey. And other than that, yeah, that is the two key economic data to look out for in today's session, which is and as well as tomorrow Asia session. All right, so with that, that sum up today's daily dose of market insights. I'm Kelvin here, wishing you all a great day ahead, and we shall speak again tomorrow. Thank you.